We'll say that we're energy independent. That also includes energy and petroleum products, right? So I think when most people think energy, they just think oil. That's just one of the things we continue to talk about, and I don't think that's about to end anytime soon.
So if you're not going to put us into a recession, then make a decision what you're going to do. Cut interest rates, and that alone could help maybe bring prices down.
We need a couple quarters of earnings that show software is going to work in tandem with AI, not that AI is going to replace software.
I agree with you, and I do believe that's going to be true. Hello, everyone. Welcome. My name is Philip Palumbo. I'm the host of the Palumbo Podcast, where we interview some of the most successful founders of businesses to talk about exit planning, as well as talk to market strategists and economists about their perspectives on the current state of the markets. Today, we have with us Jack Janasiewicz, who is a CFA, portfolio manager and lead portfolio strategist at Natixis Investment Manager Solution, overseeing $70 billion, and also is a PM for over $5 billion. Jack has over 25 years of investment experience and focuses on global economic and capital market themes and how they translate into real world portfolio construction and asset allocation decisions. He's a widely followed macro voice, appearing regularly on CNBC, Bloomberg TV, Fox Business, Reuters TV, and the Schwab Network. And he's frequently quoted in outlets like Wall Street Journal, the Financial Times, Bloomberg, and Reuters. Before joining Natixis, Jack served as chief strategist at Duet Alternative Investments and previously spent nearly a decade as chief strategist and portfolio manager for global macro strategies at Macquarie, as well as 7 years as portfolio manager at Deutsche Bank Asset Management. So, Jack, looking forward to have you on the show here today. Thank you for your time. I appreciate it very much.
Yeah, thanks for having me on.
So, Jack, if we just start with explaining to my audience exactly what you do on a day-to-day basis.
Sure. Yeah. So I have a dual function here. I serve as our lead portfolio strategist. So that simply means I'm basically looking at the world and turning those basically ideas that we're seeing from a macro perspective into portfolio investment ideas. And then as I double as a portfolio manager, some of those ideas that we're looking at from a macro perspective, translating those into portfolios, we're actually implementing those ideas in the portfolios that I help to manage.
Just to help the audience, from a macro strategist, what most people like you do is, so there's a couple ways that we can look at investing, right? So we, at my firm, we do invest in individual businesses, and it's more a bottoms up type of strategy versus top down. So top down would be sort of what you do, where you're looking at the current macroeconomic environment, and you're seeing certain trends perhaps, which again, you'll go into. And then maybe from there, for example, if you see a trend in a sector like energy, then you'll say, okay, within energy, what are the best companies to own? Which I know you don't choose stocks, but that's the way we would think of it. So does that sound about right?
Yeah, 100%. Yep.
From a macro strategy standpoint, what asset classes do you cover?
Running the gamut. So from an equity perspective, we're looking at equity markets around the world. So U.S., international, emerging markets. On the fixed income side, looking at treasuries, corporates, high yield, going up and down the entire capital structure there, as well as international bonds, whether it be global developed or emerging markets, both local currency denominated in dollar debt. And then to a lesser extent, looking at the commodities market as well. So literally anything that's investable around the world, we're taking a look at. I'm following and trying to come up with ideas and potential portfolio impacts and how to take advantage of these things.
Yeah. So let's start with this more like high level, right? So the way I look at bonds and fixed income in general, right? Looking at the 10-year today at like 4.3 approximately, today's April 29th. The issue I have with bonds in general within client portfolios, and I do have bonds within my client portfolios, but I try to minimize it as much as possible, because over long periods of time, the return for bonds, when you factor in taxes and when you factor in inflation, could be close to zero or even sometimes negative. Yep. What is your view in regards to that?
Yeah, I mean, from our perspective, safe things like treasuries, for example, are really trying to dampen some of the volatility within the portfolio. They give you that inverse correlation. So, when bonds are doing what they're supposed to be doing, when equities start to sell off, you'd expect to see bonds rallying. And so you get a little bit of that equity risk offset within a portfolio context. We've had a little bit of a struggle with that over the last couple of years, largely because of the inflation concerns, right? As inflation starts to push higher, bond yields react accordingly. They push higher, so bond prices go lower. And as bond prices push higher, that obviously pushes the equity market lower. So that traditional inverse correlation can come and go depending on what the catalyst is. More recently, the inflation backdrop has been that catalyst. But slowly we're seeing that correlation come back into vogue. But again, it's really acting as a volatility damper. And even more importantly, it's actually a source of funding. So when you do get a market drawdown, you can take some money out of the bond market and put it into the equity market to take advantage of opportunities that arise after equities sell off.
Which I agree with you, Jack. But the issue is over the past couple of years, like you just said, right, there's been more of an inflation problem. Inflation's been sticky as a result of that. Inverse correlations with stocks and bonds really haven't followed suit like we've seen over the past 20, 30 years. So based on that, what changes are you making in your portfolios, if any?
And there's a couple of things to think about on that front, right? You can also start to consider a little bit more of maybe the non-traditional route. And in this case, you might even start to think about things like hard commodities and precious metals. That gold backdrop certainly has come back into vogue. And there's a lot of other things that are, I think, happening under the surface there that are helping to drive that sort of relationship back to precious metals here. But, again, that's another way to sort of diversify away from maybe using treasuries as a volatility dampener in there. Maybe you can start to allocate into precious metals or even to a lesser extent, maybe cryptocurrencies, because, again, you're just looking for that vol dampening mechanism. And more recently, we're starting to see those come back into play. So alternatives there. To your point on inflation, we still think the best inflation hedge really is the equity market. Right, as prices move higher, that just basically translates right into top line revenue growth. And as long as margins are still pretty healthy, that's going to just act as an amplifier right to the bottom line for earnings. So, from a perspective of the overall portfolio, probably the best hedge for inflation is really the equity side of the equation. So,
in regards to fixed income, if we're nervous about inflation being a problem, then will you just stay short duration under like 1 year just to keep that in a portfolio as dry powder? You're not going to get volatility with that. Or are you making, or historically have you made duration bets as well?
Yeah, we'll actively manage the duration of the portfolio. And so to your point, we've been largely sitting a little bit more in sort of the intermediate to the short end of the curve as well. So from a duration perspective, a little bit underweight that bigger picture backdrop. And a lot of that has to do with some of the things you're talking about, right? Some of the inflationary backdrop still remaining a little bit sticky. We're seeing a little bit of a steepening in the curve, so to speak. So I think that gives us a little bit more leverage with the front end of the curve. So it's another place where we're a little bit more optimistic, but actively managing that duration bet up and down the spectrum. And yeah, we are tilting a little bit more towards the front of the curve. So in regards to our portfolios with regard to the benchmark, we are actually underweight duration from that perspective.
Right. With a perspective that if the Fed were to cut rates, you could see bonds rally a bit, and that's where you can make some return.
Correct. And I think the play that we've sort of become sort of positioned accordingly for is a little bit of a bearish steepener, if you will, which would mean the long end sort of pushes back up a bit, but the front end still stays somewhat anchored because of that expectation for at least the Fed to remain on hold and potentially maybe even start to cut, which I think is a little bit farther out. But that just changes that shape of that curve, and that's what we're sort of trying to play for right now.
Just to keep it simple for our audience, right? So one of the reasons why you invest in fixed income, and even me as well, it does dampen some of the volatility. But again, because inflation's been problematic, that inverse correlation has changed, meaning that when one zigged, one zagged, and that dynamic has been changing lately, and fixed income has been a great diversifier. So then you talked about some alternatives being commodities. Now, so commodities I've studied extensively. I operate in an environment where I look at the environment in 4 different ways. One, inflation is either accelerating or inflation is decelerating, or growth measured by economic GDP is either accelerating or GDP is decelerating. And when I studied commodities going back, I believe it was like 100 years, what I've noticed is that the return is like 2 to 3%. So commodity as an asset class is not a good returning asset class. However, we've seen many, many times is that, especially in 2000 with China, 2000 went on a secular bull market in commodities, right? So there are these periods where commodities can really outperform. Do you believe that we're in a secular commodity bull market today?
Yeah, and I think obviously supply and demand is what drives asset prices, and not surprisingly, it's going to do the same thing with what we're seeing in the commodity space. And I think the backdrop from a geopolitical standpoint is changing, right? And that's this idea of becoming maybe a little bit more isolationist, less, globalist, if you will. And that really puts an emphasis on national security, right? I think we've seen the supply chain disruptions, whether you go back to COVID to what we're seeing today. And that just means you're being more reliant on partners around the world that maybe become unstable or unfriendly to you. And as a result, that puts a lot of pressure on national security interests going forward. So I think what we're seeing now is this national security theme working its way through the system. And that tends to fall back to, raw materials, right? We're talking about trying to procure all these rare earth materials, for example, because a lot of those are important, not only just for the manufacturing of microprocessors and chips, for example, but also in the military usage there. So from that perspective, that national security theme, that's, I think, changing the dynamics for the commodity backdrop, but it's putting an underlying bid or an underlying demand to that whole backdrop. And so I think that's the supporting factor here going forward. And that's why I think commodities actually could continue to do very well. You're starting to see that concern over national security. It's not just here in the U.S., but you're seeing it now in Europe because of the concerns about where NATO goes. Obviously, China. You're getting these multipolar spheres that are starting to develop, and each one of those is going to basically need to rely on themselves. And that means you got to procure those raw materials for yourself, and that puts that underlying bid to the market.
Yeah, I would agree with that. And let's talk about oil, right? The oil is a big function of a lot of commodity funds that are out there today. So obviously with the Iran war, I do believe peak escalation is behind this. I obviously can be wrong, but I do believe that. But even so, if this Iran war goes away, it's not going to go away easily, but let's assume it goes away. Do you believe that the price of oil will be higher than pre-Iran war due to some infrastructure damage that has occurred, due to the war?
Yeah, I think you've got not only just the infrastructure damage, but, again, I think what we've seen is the ability for Iran to basically flex its muscle over the Strait of Hormuz. And, this idea of them now charging a toll going forward, that's going to have to be reflected at some point and somehow in terms of a geopolitical risk premium embedded in oil prices, right? Because you can now certainly see how Iran can take basically the global economy hostage by shutting down the straits, forcing oil prices to skyrocket up and really start to cripple a lot of these economies and, basically force whoever it is to come to the negotiation table. So the ability for them to take the oil market hostage and really, put significant pressure on the global economy, that's one of the levers that's going to remain going forward. And so as a result, I think you have to see a little bit of that geopolitical risk premium factor into oil prices. So I wouldn't be shocked if we have a little bit of a higher premium going forward. Maybe if you said equilibrium was around $60 a barrel, maybe it's 70, but I think an inherent premium does get built in here going forward.
President Trump continues to talk about that we are oil independent here in this country. And he continues to mention that. However, people say, well, okay, so if we're energy independent as a country, then why are the prices at the pump going up?
There's a little bit of a trick there, right? When people say that we're energy independent, that also includes energy and petroleum products, right? So I think when most people think energy, they just think oil. And we're actually a net importer of oil. And a lot of that goes back to the idea of where we had been getting our oil from a historical perspective. And a lot of that was coming out of, for example, Latin America. And Latin America produces this heavy crude. So the refiners that have been built in the United States are really set up to refine heavy crude products. Unfortunately, what we produce here in the United States from shale, for example, is not a heavy crude product. So we can't refine some of this stuff. So that's an infrastructure bottleneck that we have here. And as a result of that, we actually have to be net importers of oil. But after you crack oil open and all the sort of distillates that come from that, we then re-export those out. You put all those together under petroleum, and yeah, we are a net exporter. But just going back, we actually are importing oil. Simply the problem there is because of what the refiners here in the United States are built to refine, and that's just a product that we don't produce here in the United States.
Right, and then also the pricing of crude is global pricing. Correct. It's not like Exxon and Chevron are going to give us a deal here in the United States. But technically speaking, if we become so independent, we can create our own market eventually if we really want.
And I think you see that in natural gas prices, right? Because for most of the United States, right, we basically get our own natural gas distributed across the states. And as a result, when you look at natural gas prices in Europe, for example, substantially higher, you haven't seen that inflection here in the United States. It's because we're broadly insulated from the international market because everything that we produce here in the United States is basically sold domestically. The other side of the equation, back to your original question there on oil prices, we still do export a lot of those petroleum products. We are active in the global market, and as a result, we're a little bit more impacted by what's going on the global stage. But I think the big difference, and you're hitting on it, and that's, I think, why you're seeing maybe Europe or Asia getting hit a little bit harder with higher oil prices. they actually physically can't get oil, right, because of what's going on. We can get it. We just have to pay a higher price for it. There's a big difference between paying a higher price, but you still get it, versus these countries just can't even get it. That's a problem.
I agree with you. So let me tell you my personal view about inflation and interest rates, because it relates to commodities, what we're talking about right now. It relates to fixed income and relates to positioning. So my view on inflation is that services is the problem. Wages, insurance premiums, hotels, restaurants, and those rates and prices, they're not going to voluntarily decrease them, right? No matter what the Fed does,
right?
Unless the Fed puts us into a recession.
Right.
Nobody wants that because we have high debt, high deficits. So follow me on this, Jack, right? So the Fed doesn't want to do that for, we just said, political reasons, et cetera. But the only solution to get us to 2% is to put us into a recession. So if you're not going to put us into a recession, then make a decision what you're going to do. Cut interest rates. Because if you cut interest rates, that could bring supply of housing on the market. And that alone could help maybe bring prices down, because now buyers have control, not sellers, because there's an influx of supply. That's number one. Number two, middle income families, lower income families is part of the concern of the Fed, right? But keeping rates high is hurting those same people, because they borrow through car loans, mortgages, which they can't get a mortgage right now. Rents get affected by higher interest rates, credit cards. And so this is impacting them, keeping rates up. Out of all the G7 countries out there, we got the highest rates. So I would say that you have to make a decision as a Fed. Enough with this data dependent nonsense. Let's make a decision, look forward. AI is going to increase efficiency, productivity. It could create a deflationary effect. And by lowering interest rates doesn't necessarily mean that inflation is going to spiral out of control. So I got to tell you, this is probably the most frustrating thing. And that's why I think Warsh is the right guy. I really believe that. And we'll talk more about him in a moment. But what is your view about exactly what I just said?
Yeah,
and you don't have to agree with me.
Yeah, there's a lot of moving parts in there, and I think some of the stuff that I would agree with, some of the stuff like we could have a debate over, but I think this kind of brings back to a political point in terms of, I think, I was just down in D.C. a couple of weeks ago, and we met with a bunch of the constituents down there. It was something that came up over and over. It was the affordability issue, right? And I think what we're hearing from the Democrats is certainly they're going to go after the affordability issue because they know that's a linchpin here. And we've seen, I think, the Trump administration try to get out in front of the affordability issue. We got sidetracked with some of the stuff that was going on with the war, but came out and made comments about trying to cap interest rates on credit cards, trying to prevent institutional buyers from buying homes, on the market. A couple other things that they had put out there, but it comes back to the affordability issue, and that really plays into this sort of K-shaped economy where the upper income bands are still doing very well. The lower income bands are getting squeezed, and they're getting squeezed because they're more susceptible to the interest rate backdrop, more susceptible to higher prices because, the things like groceries, things like fuel, energy costs are a higher wallet share than the upper incomes. And so these sort of things can have a pretty significant impact to them. And so part of the solution potentially for the K-shaped economy is to try to bring interest rates down. I think the problem here is that you're looking at a Federal Reserve that is much more pragmatic and much more, to your point, data driven. Unfortunately, I think they're going to want to see the data before they start to move, which probably means interest rates remain sticky for a lot longer. And I think that's going to continue to exacerbate this sort of K-shaped economy because it's going to keep that affordability issue in play. But yet corporate profitability has basically learned to live with these at this level of rates, and the profitability continues to grind higher in here. And as a result, the stock market probably continues to push higher. So again, who's benefiting from the wealth effect? It's the upper income bands. So I think you're going to continue to see this dispersion, this widening in terms of that, the haves and the have-nots, and that's going to continue to, I think, put pressure on the social backdrop here. But unfortunately, I know Warsh, and you sort of alluded to the, Warsh potentially being a little bit more open to trying to push rates lower. Myron, the same sort of thing. I think the problem we're going to run into there is you're still looking at a voting institution, right? You've got 12 people that are going to have to vote. you're going to need 7 guys on board to push rates lower. I'm not sure if we can find 7 guys at this point because we're still looking at an academic Fed that's going to go back to what you were just referring to as the data dependency. And I don't think you're going to see that pull through yet at any time soon. So I think maybe the best case we can hope for here is the Fed remains on hold and isn't hiking rates. And maybe I think we're a little bit more looking out and thinking that the labor market is going to continue to slow and that wages actually continue to ease off. And that puts a little bit more downward pressure on the potential for consumption to slow, which means the economy could slow a little bit. And we're talking about towards the end of the back half of this year, that might be the impetus for the Fed to begin to cut rates. So we are in the camp of sticky high inflation, but if you look at the balance of risks, whether it's between higher prices or the labor market, I think the labor market is going to become more of an issue as we move to the back half of the year. And that's going to change that balance of risks for the Fed, and they'll probably be more prone to cutting. So we're actually believing we're going to get 1 or 2 cuts by the end of the year, certainly 1, and that other one may get pushed in the beginning of next year, but we're actually in that camp.
Yeah, I would agree with you. And so the idea behind this whole data dependency drives me crazy because if you think about it, Jack, if you and I were data dependent, we would never make money for our clients in our own self.
Too backward looking.
Right? It's backward looking. And so that's number one. Number two, so let's be pragmatic about it, right? So we know that factually speaking, the Fed pretty much always gets it wrong. They're always early to the game. Look, go back. You know this. This is stuff, factual stuff. So I'm talking about factual stuff. So factually speaking, if you have all these academics behind you that are being data dependent, they're all getting it wrong.
Yep.
So it's frustrating because I really do believe you got to open up the economy, you got to open up the market, and a big part of that is lowering interest rates. I really, really do fundamentally believe that. But we can debate that back and forth. But anyway, so let's move on to equities, right? One of my favorite subjects is I'm sure it's yours as well. So I mean, it's been an incredible backdrop, right? 3-4 quarters, year-over-year growth, 10% plus. Right now, the first quarter of this year is looking really strong. I guess so. First of all, do you believe that we're in a secular bull market?
Yeah, listen. I think there's some themes here that are have longevity to it, and that's really going to center around the tech space, right? And I think you're seeing the AI trade continuing to sort of work. Whether it's a question of semiconductor chips, the picks and shovels, the ability to supply power, so power generation, the infrastructure along that. That's one of the themes that I think continues to work its way out. And when we start to talk about what are you paying attention to, we sit here and all we're worried about are what are these hyperscalers saying and what's that CapEx budget looking? Because if we see any sort of significant decrease in CapEx spend going forward on this sort of stuff, that's going to throw up all sorts of red flags. Are we seeing that yet? Absolutely not. If anything, we're seeing just the opposite. The chip makers are saying, listen, we just can't keep up with demand. There's a shortage of compute. These things are still, in place. So to your point, that's just one of the themes we continue to talk about. And I don't think that's about to end anytime soon.
I agree with you. I mean, listen, demand is there. I mean, that's not debatable. Yep. It's just the part is that it's going to be interesting to see from a lot of these hyperscalers is how is it going with the data center build out? That's one. I think that's a bigger question. Really, CapEx, right?
And I think we're seeing it on the bottlenecks front, right? What are they complaining about? Why are some of these data centers slow to being finished? They can't get the raw materials. They can't get the energy. Those are the sort of things that are holding this back. And so again, that's just incremental demand. We've got clients down in the Houston area where, Abilene, where they're building one of those big data centers, and they're just saying, hey, my air conditioning needs to be fixed. I can't get an HVAC guy to come out. It's because all the HVAC guys are out building, helping to build the data centers out there. These things are huge.
Yeah, it's tremendous. It really is. And if you look at Bloom Energy's report, their earnings report, I mean, it's unbelievable. It's literally, Jack, it's a year over year, like 1,000% on EPS. I mean, they're just through the roof because they can really supply power, not infecting the grid, and do it in a low emission way. So when you see companies like Bloom Energy and Oklo, and like you said before, there's like the second derivative of this whole entire play, which is the power, the infrastructure,
and I think
the demand.
Some of this actually, I know we sort of tie this back to the AI infrastructure build out, but I think it's also just shining light on the fact that our grids are basically old. They need to be upgraded. You're shining a spotlight on infrastructure in general. So you can take the AI trade and put it out to a bigger picture thing here. And I think, again, that's very supportive for that theme for the backdrop.
Yeah, I agree with you. And that's all. Listen, what people, it seems like we're going to have stimulus for our economy for a good period of time, which I think will continue to create a good secular bull market. That's why we're seeing, I think, earnings very strong. I think it started with, I mean, even if you go back to 2009, 2010, I mean, you really had tremendous federal stimulus. You had low interest rates. I mean, there's a direct correlation with the S&P going up and that stimulus. Yep. That stimulus is still there, but it's waned a lot, obviously, since COVID. But now you have this private sector stimulus, like we just talked about, the AI spend. So that's why I believe the secular bull market continues, and perhaps you do as well. Mm-hmm. So theme one is, let's call it AI, that you see in equity markets. Are there any other themes that you're seeing?
Yeah, so along the lines of sort of what we were talking about in the opening comments there, national security, right? You can still make the play for sort of reshoring, onshoring. And so, again, that goes back to more of just industrializing the economy again. So, within that space, I think there's a bunch of different pockets of the industrial base that continue to benefit from that sort of national security interest going back and forth. So, industrial, and again, this overlaps with the AI build out theme as well. That continues to, I think, play its way through the economy. We can also talk about deregulation coming in the financials, right? You continue to sort of see some changes there. I think you're going to see some of the gloves taken off in terms of some of the limits that have been placed on banks, preventing them from actually merging and buying other banks. So I think you're going to see some M&A kicking in there. And I think you're also going to see that the loan books expanded, because I think what we've come to see is that we over-regulated the banks. And as a result, it forced people to have to basically tap into alternative means of getting credit, i.e. private credit. What's getting all the headlines right now? Private credit. The problem with private credit is it's sort of in the gray area. It's really not able to be followed, regulated. So from a Fed's perspective, they can't really see where these big risks might be. So I think we're going to see the pendulum swing back in the other direction, where they sort of want to deregulate what the banks can do. So some of that money maybe flows back into those public markets. It's a little bit easier to see. The Fed can then kind of see where the potential risks might lie. So as a result, I think you're going to see that sort of dereg really benefit credit being extended through the proper channels in the banking side. So that's good for the banking industry.
I agree with you. I love it. I really do. Financials, I think, is strong right now. Yeah. I like it. I'm positioned in JP Morgan. Industrials, I really believe, has a great wind at its back. I mean, a lot of them really has moved from these levels here, like Veranova. I'm not in it right now. I love to be in it.
But the beauty of the stuff, though, is you see the multiples. They grind up, and I get clients who will say, "Well, it's kind of an expensive multiple," but all of a sudden, earning hits, the E fills in, and all of a sudden, because the E is the denominator in the PE. The PE drops back down to something in the 20s again, so that they grow into these multiples.
Yeah. It's interesting you said that. Again, I don't know how much you follow individual securities and multiples and things like that. I mean, you just mentioned it, perhaps you do, but like Costco, for example, and Walmart, right, trading at 40 to 50 times forward multiples. I mean, most likely their EPS will grow. I would say definitely more than GDP. I think they'll probably grow 8 to 10%. So if you figure EPS growing 8 to 10% over the next 5 years, the question is in 5 years, what's the multiple going to be for Walmart and Costco? And it's amazing how the market's assigning a higher multiple than NVIDIA. And you have any thoughts around that?
Yeah, part of me thinks that some of this is maybe the potential for AI to sort of manifest itself more quickly, if you will. So you start to see sort of that margin expansion, right? Because and you've heard some of this from some of those retailers, right? They're getting better at managing inventory. They're getting better at predicting what consumers are going to be buying, those trends. And that, I think, basically enables them to manage a lot of their inventory a lot better. And as a result, it enables them to cut costs. And so that margin actually starts to become a little bit more of a leverage piece for some of these companies. So part of me believes maybe the higher multiple is being placed on them because of the potential they're a net beneficiary longer term of AI. And so that's part of where the AI sort of cycle starts to shift to. It's going to be who's going to benefit from this stuff, and I think that's one of the areas that we could see that, and as a result, willing to pay up a little bit of a higher multiple for some of those names.
Yeah, I agree with that. I do think I know everybody's focused on the hyperscalers, but the question is the other 493 companies. How are they going to? What investments are they making today? And when you think about it, everybody's focused on the hyperscalers. Let's say they're spending $700 billion this year in 2026, but the question is, what are the 493 companies? Investing in AI, what does that number look like? It's got to be, it has to be, I know one company's spending, $60-70 million. That's one company. Right. There's 33 million companies that are private, public in this country alone. I'm spending money on some of this stuff, right? So, at least a couple, 3,000, 4,000, maybe 10,000. I'm only one little company.
One of the things that I think is really interesting, we're kind of talking about it, so I just wanted to highlight this. It's, if we look at, we like to decompose the return of the S&P 500. So, for example, if I just did it the other day, the last 2 years, decompose the return of the S&P 500 between how much is being driven by earnings growth and how much is being driven by multiple expansion. And if you go back over the last 2 years, actually multiples have actually contracted. And you can go back and look, for example, at tech. We actually saw the tech industry, the multiple contracted there worse than what we saw on Liberation Day. We're basically looking at multiple contractions similar to what we see.
You're talking about just recently, the contraction?
Yeah.
The recent meltdown that we just had.
A couple of weeks ago. Yeah. And so you start to look at, the driver of the S&P, it's been almost 100% earnings growth. And so the thing that I find interesting is if I look at where net profit margins have been relative to where they are, they're continuing to grind higher. And if I look at the expectations for end of 2026, they're even higher. So between first quarter, second, third quarter, and fourth quarter, they're continuing that ascent. So it's interesting because when you look back in history, very few times do you see multiples actually contracting at a time when net profit margins are expanding, right? People want to pay up for that operating leverage, so they'll pay a multiple for it. You're actually seeing just the opposite. So the whole reason why I think this is interesting is full year earnings right now are expected to come in at something close to 18, 19%. If you get a couple multiple turns on there, you do the math on this stuff, you can get to a pretty good year for equity returns. And again, you're seeing multiples contract while you're having earnings going up and to the right and net profit margins continue to grind higher, which is kind of unheard of. So the ingredients this is setting up pretty good.
I love that. And that's one of the things, I think Mike Wilson talked about it at Morgan Stanley. You can get both the earnings expansion and you can get multiple expansion. Yeah. And as a result, I can see the S&P at 8,000 at the end of this year. There's potential for that. But why do you think multiples are not expanding?
I think this is just that risk premium that gets built in because of the uncertainty, right? And you could say uncertainty, whether it's from a geopolitical perspective or uncertainty from we just don't know the impact from AI. I mean, look at the software sector, right? You continue to hear about the earnings from software. They're doing okay, but yet software is re-rated 30, 40% as a result of that. And that's just because uncertainty. Is AI going to kill software? I don't think so, but I think they're in the show me, prove it to me stage. And until you actually see the numbers that show that AI isn't killing software, I'm going to basically sell it down, i.e. we're going to see multiples contract as a result of that. So I think the less clarity you have, that's when you see the derating. And I think people are just sort of saying, hey, I don't really know where AI is going to hit on certain sectors. We're just going to sell it down and sort of re-rate it as that uncertainty unfolds. And then until we get greater clarity on that, they're going to stay there.
Jack, you and I have been doing this for a long time, right? So when you look at the software sector as an example, and the thing is that when you look at these companies, how they're operating, if you look at ServiceNow's earnings, I thought they were absolutely phenomenal. I think everybody would agree with that. I mean, they had some Middle East disruptions, whatever that may be. And, ServiceNow is going to report. I mean, these companies are performing fine right now. Today, they're performing fine. And it's like, everybody's said this so many times. It's like they go into trial, they're guilty before even proven, innocence, right? So, and we know that. I mean, could the market be that wrong, or is the market, in your experience, has the market nailed it correctly?
I think it's a combination of no on both. The market has not gotten it right, and I think the market is still just scared, right? And I think what's the easiest thing to do? Sell first, ask questions later. And I think that's kind of what we're in right now. And, we can get into some of the other, the market dynamics, I think, that are shifting a little bit. But, one of the favorite pair trades out there was long semiconductor, short software. But the point I want to get to there is I think at the margin, you're seeing a lot more leveraged players having an impact, right? Whether it be long, short equity funds, hedge funds, whether it's CTAs, commodity trading accounts, even just from a retail perspective, right? You got zero DTEs, there's a lot of different ways that you can sort of juice the system through leverage. And I think that's exacerbating some of these moves. And so from this perspective, where it was sell first, ask questions later, some of the stuff can get exacerbated. Then you get the momentum players that pile on. And you can kind of see how this really pushes this to extremes. So I think there's a combination of fundamentals, but they get pushed to extremes because of the technical players involved here. I think you need a catalyst to turn that around. And my gut says the catalyst will be, we need a couple quarters of earnings that show, hey, we're going to actually, software is going to work in tandem with AI, not that AI is going to replace software. And you just need signs of that.
I agree with you, and I do believe that's going to be true. Jack, I want to finish off with this. So you've been on CNBC as well, Bloomberg, all that type of stuff, right? And many people that go on there make prognostications of what they believe markets are going to do. Like you said it perfectly. Like, there are people long semis, they're short software, right? When I since I've been studying investments, I've been a student of Buffett and Munger, and I just feel like their way of investing is so pragmatic, which is how I invest for my clients here, right? I don't try to time the market. I don't go long something, short something, right? And I feel like the investment community really overcomplicates things. Most hedge funds out there that are long something, short something, when you look at their actual returns, it's all ordinary income. So even if they're averaging 12 to 14%, their real return is 7, maybe even less. Right. And so all that trading and all the expense of it's like, for what, right? And there are very few talented people out there that could actually execute. Yep. But even the most talented money managers out there, right, show those types of returns, but it's all short-term ordinary income, which doesn't help. Right. So I just wonder why many investors and people out there, talking heads, make it so complicated, where if you just own a great business at a fair value and you hold on to it forever, as long as they maintain their economic moat, and just own a handful of those, like, why do we overcomplicate things?
You can't sell ads on CNBC if you don't. That's why.
You're right. But I mean, that's one of the things I try to do when I'm on CNBC, is to be that voice of reason. Listen, to put things in perspective.
We tell our clients, we simplify it to your point, right? Listen, the market going all the way back to, I think, 1928 or 1929, I can't remember the date we pulled it from, but the market goes up, I think, 70 on a calendar year basis. The market goes up 72% of the time. Of those times it goes up, 50% of them, the market goes up more than double digits. That's what you're fighting against, right? You're fighting against the odds that are in favor of the market going up. And when it does go up, double digits. Like, to your point, we don't overcomplicate it, right? What are the things that create problems? It's a recession. How often do we get a recession? Not very often. Recession is when you get 15, 20, 25% or more drawdowns, right? I'm not in the business of trying to call 5 and 10% corrections in here. I've tried it when I made my mistakes growing up. I'm terrible at it. I can't do it. It's 50-50, right? Yeah. So why bother? I'm worried about the recessions, and I think I have a pretty good call on when we're going to get into a recession. That's when you're going to see the market really tank, and that's where you're worried about it. Other than that, avoid the noise. To your point, buy good companies at reasonable prices. Hang on to them. Market goes up 70+% of the time. I'll play with those odds. If I told you that at blackjack table in Vegas, you'd win 70% of the time, I don't think you'd walk to the table. You'd be running to the table.
I love it. I agree with you. I know I said this the last thing, but I just came to my mind. But I would tell you, Jack, the one thing that holds me back from being fully invested with clients in equities is one thing. It's this person on my shoulder that's saying, don't forget about 1929. Yeah. Don't forget about 1929. Right? So there are some parallels from 1929 to what it is today, right? You had the roaring 20s that created an overvalued market, which, valuations alone don't create a bear market, but debts were high back then. And then you had a major creative. So it's like, I feel like, this country has kicked the can down the road. We have the debt to GDP is very, very, almost at record high levels. Deficit's still wide, and we're not even a recession. What happens if we have a recession? Deficit's going to get even wider. You can't fix that problem. And so this is the reason why I rein in risk. This is the reason why I diversify. Do you think about the Great Depression? Because that is one piece that really could hurt us as investors.
Yeah, I think certainly that, those are the key risks that we look at here. And that goes back to sort of, the recession calls are the ones where you see those significant drawdowns in equities. That's what I feel as a portfolio manager and as a risk manager, that's what I'm trying to protect against. And certainly the things you've just talked about are things we're paying attention to. I hate to say it, but I would say right now, our view is not yet. And I think it's something to continue to sort of to pay attention to. But are we at the precipice where this could basically start to roll over and really create a problem? Not yet. Something I appreciate the fact that people are paying attention to it. The fact that you're on watch for it, that's a good sign, because it's going to sort of prevent it from really getting out of control. But as we continue to sort of chip away at it, it's, again, risks that should be noted. I'm not ready to sort of, rein in the portfolios right now to sort of dial it all back because of that. I think we're still okay, but we're paying attention to it. That's for sure.
So, Jack, what are the top indicators that you use because you made some pretty good calls in regards to recession. What would you say from your career? What are the top 2-3 economic indicators or macro indicators that you look at that say, oh my gosh, like,
yeah, I mean, we'll keep it really simple, right? It's two things, right? One, it's going to be really the labor market, right? That's the key to all of this stuff. So, from a layman's perspective, if it's just simply paying attention to, initial jobless claims, we can argue that there's some faux pas in that, so to speak, but we're paying attention to what companies are saying with regard to the labor market. And if the labor market's starting to show some signs of crumbling, that's a problem. The second one, which usually tends to be a problem, is when the Fed is hiking rates. So again, when the Fed is sort of on its hands, not doing anything, the market tends to figure itself out. But it's when the Fed starts to hike rates, financial conditions begin to tighten, that's when you start to get a problem. And right now, we're, like I said earlier, we're more in the camp of the Fed ends up cutting as opposed to hiking. So we can sort of take that off the table. And, the labor market's holding up okay. It's not great, but it's also not falling off a cliff.
I agree with you. It's amazing. Yeah, I agree with you. It's amazing in February 2022 or March 2022 when the Fed started to hike on one of its biggest hike and rate campaigns ever. Yeah. And then we didn't go into a recession. Were you surprised by that?
Yes and no. Yes off the bat, just because the knee-jerk reaction has always been when Fed's hiking, that's a bad thing. But then you start to sort of think about what happened during COVID, and we sort of became immune to higher rates because everybody had refinanced, everybody was sitting on piles of cash. So the transmission mechanism for higher credits, for the higher price of credit, was at least delayed at that point. I think it's a little bit different today, whereas if you started to hike because cash cushions have been drawn down. Maybe you and I are locked into a mortgage rate because we refied during COVID, but you've had, the younger buyers really haven't had that. And maybe they're sitting in a floating rate mortgage because they just had to buy their house, a year or two ago. That stuff starts to hurt. So I think there are some analogies there, but I think the starting point is what matters most. And I think we're at very different levels today versus COVID. So we'll see how that goes.
Yeah, Jack, this was awesome. I really appreciate it. Great feedback, great perspective. We covered it all. We covered all the bases. I'm sure we could talk for another hour together, but it was really nice meeting you again. And thanks for coming on. I look forward to having you on again one day.
Awesome. It was a lot of fun, Phil. Thanks for having me on.
All right, Jack. Thanks a lot. Be well. Take care. Enjoy your day.
You too. Take care.